One of the biggest players in the Canadian energy sector is Enbridge, and we are going to look and see if Enbridge is a good investment for your portfolio. In addition to that, if you stick around until the end of the video, I will show you a way to make even more passive income from Enbridge. It is time to drill down and see if we hit pay dirt, and that we will begin right now. Enbridge began as Interprovincial Pipeline Company, or just IPL, which was initially incorporated by Imperial Oil back in 1949. They began in Alberta and expanded pipelines east into Saskatchewan, and within a few years, south into Wisconsin, which came with a name change for the American part of the business to Enbridge Energy Partners. By 1953, they had expanded further east to Toronto and down into New York as well. It was also in 1953 that they were first listed on both the Toronto and Montreal stock exchanges. There were a lot of further expansions and mergers, also some acquisitions, as well as some big projects. In the 1990s, for example, they built the Athabasca pipeline from northeastern Alberta to connect to their main pipelines. By 1998, IPL consolidated their overall name into Enbridge Incorporated. As we moved into the 2000s, Enbridge was looking to expand into renewable energy, and they bought their first wind farm as they have been focused on a goal of being the leader in renewable energy in Canada. They also added more pipelines. But by 2009, they bought the Sarnia photovoltaic power plant and expanded it to produce 80 megawatts, which was the world's largest photovoltaic plant at that time. Even today, Enbridge has pledged to become net zero by 2050. In addition to that, they were recognized as one of Canada's top 100 employers. Currently, Enbridge is a multinational pipeline company with more than 17,100 miles of crude oil pipelines and 23,800 miles of natural gas pipelines. Their pipeline is the longest in North America and transport about 20% of all the natural gas consumed in the United States. In addition to this, they have several renewable projects, including wind and solar assets, waste heat recovery, geothermal, power transmission, and hydroelectric. When we look at their fundamentals, we will see that an overall theme for Enbridge is expansion and investment in their growth while trying to maintain a high dividend payout. Enbridge has a ticker of ENB on the TSX and also on the NYSE, New York Stock Exchange. Their market cap is $115.1 billion with a beta score of 0.94, meaning they are just a little less volatile than the market average. They have a very nice dividend yield of 6.11%, which is one of the highest you will find in the Canadian energy sector. This may be a part of the reason they are so popular with investors. That dividend is paid out quarterly in the amount of 86 cents per share. Remember, if you stick around until the end, I will show you a way to make even more than that on Enbridge. Their price to earnings ratio is 19.60, and their earnings per share are $2.87. That looks good, but there may be more going on behind the scenes, so we need to drill even deeper. The average PE ratio in the Canadian energy sector is 8.6, so Enbridge could be looked at as a poor value based on that statistic. If we look at their price to book ratio, which is a comparison of their market capitalization to their book value, we get 2.1, which is a little higher than the sector's average of 2. What is going on? Part of Enbridge's issue is their short-term financial health. Currently, they have $8.96 billion in assets compared to $18.23 billion in liabilities, which, well, that's not sustainable long-term. However, in Enbridge's case, this is all part of their massive expansion goals and maintaining a higher dividend. If we look out at the long term, Enbridge is expected to grow into $159.9 billion in assets compared to $87.3 billion in liabilities. This can be risky though. It also has the potential to pay off very well for the company. That dividend is part of their problem, but they have no intention of lowering it and losing their dividend aristocrat status. Currently, their yield of 6.1% is huge compared to the sector average of 3.8%. Their dividend has been stable over the past 10 years, as well as increasing. However, their earnings payout ratio is 116%, and this is something not covered entirely by their earnings or cash flow. If we move to growth, Enbridge is predicted to grow slightly more than the sector average, but their overall revenue is predicted to grow slower. Provided the energy sector continues to boom, there are no concerns as Enbridge will be fine. However, if the sector begins to struggle, so will Enbridge. They may have some volatility in the short term, but over the long haul, they will be fine as their continued expansion pays off and the cash flow issues resolve themselves. I did not mention their growth in the last year. They had a share price of $46.95, and that grew to $56.95 for a return on investment of 21.3%. And once you add in their dividend, the total return was 27.41%. This is awesome. From an investor's perspective, this is definitely a company that is a good investment long term. With the cash issues, just be a little more cautious on the short term, especially if the sector begins to struggle. I still see them as blue chip, though perhaps a lighter shade of blue. Earlier in the video, I mentioned there was a way to make even more passive income off of Enbridge. And well, there is a split core stock called eSplit Core, Class A shares with a ticker of ENS. They are primarily invested in Enbridge, so in many ways they are like a proxy for them, but be aware they are not Enbridge. However, they are invested enough in Enbridge that as Enbridge goes, so does this split core. They offer a bigger dividend yield of 10.019% that is paid out monthly in the form of 13 cents per share. In the last year, their share price rose from $13.22 to $15.67 for an ROI of 18.5%. That makes their total return 28.5%, which is not a lot more than Enbridge. But this is more of a passive income dividend play. While energy is booming, this is not a bad stock. But if energy does begin to falter, then I would be more hesitant, only because split core will tend to provide you with a return on capital to make up for any shortcomings when paying out their dividend. And remember, return on capital payments are taxable if you are holding this outside of a registered account. The information in this video is the beginning of your research. Always do your due diligence, and remember, your financial advisor is the end of that research. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.